Tomorrow morning at 9 a.m., Eastern, the world is going to ask for 89 million ounces of silver, and there are only 76 million ounces sitting in the vault to give them. Let that land for 1 full second before we go anywhere else. The paper is due. The vault is short. And Jerome Powell just walked off the stage for the very last time. What happened at 2 p.m.? Eastern today was not a boring rate decision. It was a trap. A carefully constructed, deliberately disguised trap. And if you are watching recession warnings right now, it is because you are the kind of person who sees traps before they close. So let's talk about what actually happened today, why it changes everything for physical silver, and what the next 72 hours look like in hard numbers, not in opinions, not in vibes, in falsifiable data that you can track yourself in real time. Here is the headline that CNBC gave you. Fed holds rates steady. Unanimous decision. Boring. Back to commercial. Here is the headline they didn't give you. 3 Federal Reserve voting members, 3 sitting members of the most powerful monetary body on earth, voted today not against the hold but against any future rate cut ever being included in the statement again. On Jerome Powell's last day in office, that is not a hold. That is a hawkish dissent dressed up in a bland press release. That is the most aggressive internal split at a hold meeting in 15 years. And while the dollar caught a bit off that print and silver dipped 40 cents, the institutional money that actually understands what a 3 dissenter hold means was not selling. It was loading, because they know what comes next. But before we get to the vault math and the delivery data, I need to give you the context that explains why today was not random, why this week was not random, and why the 40% crash from January's high of $121 was not a market event. It was an operation. Follow this sequence carefully because this is where the story begins. On January 29th, silver printed $121.64, an all-time high. Screaming momentum, industrial demand at record levels. Solar panel fabricators fighting stackers for the same ounces. The Silver Institute confirming a 5th consecutive annual supply deficit. And within 72 hours, 3 forces hit the market simultaneously that had no business arriving together by accident. Force 1, the CME, the exchange that sets the rules for paper silver trading, raised margin requirements to $25,000 per contract overnight. Force 2, Federal Reserve Communications pivoted from 2 expected cuts to 1, repricing the entire rate path in a single cycle. Force 3, Strait of Hormuz oil tensions spiked the dollar index, giving every leveraged silver long a reason to panic and a margin call to answer. 3 forces, 1 window, 40% crash. Silver went from 121 to where it sits right now at $73.35. And the same voices who were screaming buy at 121 are now whispering sell at 73. You need to understand something fundamental about how this market works before the next section makes complete sense. There are 2 silver markets. There is the paper market, the number you see on Kitco, the CME futures price, the SLV ETF ticker, the Bloomberg terminal quote that every TV anchor reads off like it represents reality. And then there is the physical market, the actual metal, the ounces in the vault, the bars with serial numbers, the kilos that industrial buyers and sovereign stackers need to take physical possession of. These 2 markets agree on price exactly one time, settlement day. Every other day, the paper price can say whatever the largest leverage players need it to say. And right now, those 2 markets have never been further apart in the entire history of the LBMA CME system. The Bank for International Settlements, the institution that normally buries this data in footnotes nobody reads, confirmed last month that total silver derivatives outstanding sit at multiples of all the mineable, above-ground supply on the planet. Read that one more time. The paper claims on silver exceed the physical silver that exists on Earth. That is not a conspiracy theory. That is a math problem. And math problems have due dates. Tomorrow's due date is called First Notice Day. Every month, the CME Silver Futures contract has a moment where the holders of those contracts must decide, do you roll your position to the next month, do you sell, or do you stand for physical delivery and demand the actual metal? Tomorrow morning, that moment arrives for May 2026 silver. As of last night's CME warehouse report, 17,984 contracts are still open and standing. Each contract represents 5,000 ounces. You do the math. 89.9 million ounces of paper silver are coming due against a registered, deliverable, physically available inventory of 76.88 million ounces. The coverage ratio is 13.4%. For context, the stress threshold that signals structural risk is 15%. We are below that threshold for the 6th consecutive delivery month in a row. 6 months. Not one improvement. Not 1 month where the vault refilled faster than the paper was being issued. 6 straight months of deterioration. And the paper leverage on the entire CME silver complex right now sits at 6.9 times. Nearly 7 ounces of paper for every 1 ounce of real metal. The Silver Institute's most recent annual forecast confirms we are now in the 6th straight year of a structural supply deficit, with this year's shortfall projected between 46 and 67 million ounces alone, sitting on top of 762 million ounces that have already been drawn from above-ground stockpiles since 2021. That last number deserves a pause. 762 million ounces. That is roughly 1 full year of total global silver mine production. Gone. Absorbed. Not stored somewhere waiting to come back. Used. Consumed. Turned into solar panels, semiconductors, medical equipment, military applications, and the stacks sitting in safes from Texas to Brisbane. One of our viewers put it perfectly last month, and I have not stopped thinking about it since. As long as you don't ask for it, they have it.
Well,
Tomorrow morning, the world is asking, and this is not recession warnings telling you the vault is short. This is Robert Gottlieb, the former J.P. Morgan Managing Director of Precious Metals, the man who literally ran that desk, saying on the record this winter, there is basically no free-floating silver left. That is not a stacker on a forum. That is the man who used to control the supply chain telling you the supply chain is broken. And he is not alone. Michael Oliver of Momentum Structural Analysis, the technical analyst whose published work Tudor Jones and Druckenmiller actually read and cite, released analysis last week stating that silver's breakout relative to gold signals a repricing move to between $300 and $500 an ounce by summer. He calls what is coming a lightning form repricing. Not a rally, not a breakout, a repricing. The word choice matters. A rally goes up and comes back. A repricing establishes a new permanent floor. Keith Neumeyer, the CEO of First Majestic Silver, one of the largest primary silver producers on Earth, told his audience on April 26, 3 days ago, that silver is now in, quote, a new price regime. He said we are not going back to the old pricing that we have all been used to over the past 20 or 30 years. The man who digs silver out of the ground is telling you the old price is dead. Now think about what that means for the paper price on your Kitco screen right now. Bank of America has published a bull scenario for silver between $135 and $139 if physical deficits continue to intensify. Citigroup has a target range between $150 and $170. Even J.P. Morgan's own commodity research desk, the same institution that paid $920 million in DOJ fines for criminally spoofing this exact market, projects an average silver price of $81 for 2026. Their base case average is $8 above where silver trades this moment. And the LBMA member bank survey, the cartel's own internal forecast, tops out at $165 for the year. The institutions that run the paper market are internally projecting a price more than double the current screen price. When the people setting the paper price tell you privately the paper price is wrong, you have your answer. So then why is the screen showing $73? Why is silver down 3% on the week when the vault is empty, the deficit is compounding, and every serious analyst from the sell side to the buy side is internally screaming fire? Because the paper price and the physical truth are two different instruments. They are only forced to reconcile when someone demands delivery, and tomorrow morning the reconciliation begins. Let me show you exactly how the trap works, because understanding the mechanism is what separates the people who profit from a regime change from the people who become its exit liquidity. The CME margin hike on January 29th was not policy. It was surgery. When you raise margin requirements to $25,000 per contract overnight, you are not managing risk. You are selecting who gets to stay in the game. Retail stackers and small funds with leveraged positions get margin called out of the trade. They are forced to sell their paper contracts at the worst possible moment into a falling price, generating the very momentum the forced sellers need to trigger more stops below. The big institutional desks, the ones with deep balance sheets and zero overnight funding risk, sit back and accumulate at 65, 70, 72. They needed retail to panic. The margin hike was the panic button. The 40% crash from January's high was not a bear market. It was a clearance sale for people who already knew what the vault numbers looked like. Now layer on what happened today. Jerome Powell holds rates at 3.5 to 3.75%. Markets read it as boring, as expected, as a non-event. But inside that statement, 3 voting members of the Federal Open Market Committee tried to strip the easing bias from the language entirely. They did not vote against the hold. They voted against any signal that cuts are coming in the future. That distinction is everything. A unanimous hold with an easing bias says, we're pausing, but the next move is still down. A hold with 3 dissents against the easing bias says, the committee is fracturing, the hawks are winning internally, and the future rate path just became genuinely uncertain. The dollar index caught a bid off that print within minutes of the statement dropping. A stronger dollar mechanically pressures dollar-denominated commodities like silver lower in the short term. That is the trap. The dollar ticks up. Silver dips. Retail panics. Stops get run. Smart money adds. And the vault gets shorter by another 1 million ounces while the screen tells you everything is fine. And then there is the transition factor that the mainstream financial press has barely processed yet. Kevin Warsh cleared Senate Banking Committee on a party line vote today. Powell publicly congratulated him from the press conference podium. The Warsh era at the Federal Reserve is no longer a rumor or a market forecast. It is a confirmed calendar event. You need to understand who Kevin Warsh is and what he represents because the market is only beginning to price this in. Warsh was the architect of the 2013 taper tantrum, the moment when Ben Bernanke hinted at slowing asset purchases and global markets dropped 15% in 6 weeks. Warsh is not a dove. He is not a neutral technocrat managing the middle. He is a hard money institutionalist who believes the Fed's balance sheet is a national security liability. The dollar bid you saw today off the hawkish dissent is a preview of the regime change that begins the moment Warsh's hand is on the lever. And here is why that matters more for silver than for any other asset. When the currency regime changes, when the market finally prices in that the Fed's inflation fight is structural and not cyclical, the rotation out of paper instruments and into hard assets does not happen gradually. It happens in a compression event. Michael Oliver calls it a lightning form repricing. The word lightning is not decoration. It describes the speed. Days, not months. Meanwhile, the SLV outflows that the bearish crowd is pointing to as evidence of silver weakness are actually the opposite signal. Year-to-date SLV outflows now stand at $3.1 billion as of this morning, up from $2.8 billion last week. Every authorized participant pulling 50,000-ounce baskets out of the SLV Trust is executing a paper-to-physical conversion. The shares get sold on the open market, which shows up as a price suppression and a bearish ETF flow signal. The metal walks out the back door into private hands. The screen says selling. The vault says drainage. These are not the same thing. When the SLV empties into private custody, that metal does not come back. It does not re-enter the deliverable pool at the CME. It does not show up in the LBMA's registered inventory. It disappears into safes, industrial supply chains, and sovereign wealth fund vaults that do not report to Bloomberg. And every ounce that walks out that door makes the coverage ratio at the CME one step closer to the moment when a single $200 million player can ask for delivery and break the entire system's arithmetic in one afternoon. That is not hyperbole. That is third-grade math applied to publicly available warehouse data. This is not a market. This is a crime scene, and the crime scene is running out of evidence to plant. So here are 3 specific falsifiable predictions tied to hard data triggers. Write these down. Set your alerts. Check the CME bulletin board tomorrow morning. Prediction 1. By the close of business tomorrow, May 2026, open interest should settle between 30 and 40 million ounces standing after the first notice day rollover. That is the base case, the scenario where large holders roll their contracts to July and the system absorbs the pressure without a visible rupture. But if open interest settles above 50 million ounces still standing tomorrow night, you will see one of 3 things happen within 72 hours. An emergency CME margin hike, an exchange for physical transfer mandate pushing futures holders out of the delivery queue and into OTC arrangements, or a cash settlement clause invocation. Watch the CME bulletin board. The specific phrase to look for is orderly market conditions. In the language of exchange administrators, orderly market is the phrase that precedes a rule change. When they say orderly, they mean the opposite is already happening behind the firewall. Prediction 2, $72 is the line. Silver's structural support sits at the $72 level, and that level is being tested right now on the back of today's hawkish dollar bid. If silver holds 72 through Friday's close and Shanghai premium stays above 10% into next week, the Fed-driven dollar pressure exhausts itself over the weekend, the stops below 72 get swept but don't break the structure, and we target $85 within 30 days. With $95 as the midsummer resistance zone. If silver loses 72 on a daily close with volume, you are looking at the $61 to $65 zone before the next real bid appears. That zone would represent a 50% drawdown from the January all-time high. Historically, for silver in a monetary regime transition, a 50% retracement before the explosive leg higher is not unusual. It is in fact the setup. The 1979 to 1980 silver move from $6 to $50 went through a 47% correction in the middle of the run. The people who sold that correction became the cautionary tale. The people who held became the legend. Prediction 3, registered CME inventory prints below 70 million ounces before Memorial Day weekend, regardless of what the price does between now and then. The drainage is structural, not price sensitive. Industrial buyers do not stop buying silver because the paper price dips. Solar panel manufacturers with signed contracts, semiconductor fabs with production schedules, and defense contractors with classified procurement timelines do not watch Kitco and adjust their delivery demands. They take what they need when they need it. When the registered inventory falls below 70 million ounces, the coverage ratio drops below 12%. At 12% coverage with 6.9 times paper leverage on the complex, a single coordinated delivery request from one institution with $200 million of dry powder can create an arithmetic impossibility inside the delivery pool. Not a squeeze in the traditional sense. A mathematical failure of the system to fulfill its own contractual obligations. At that point, the exchange has two choices: change the rules or admit the game is over. And if you have been watching this channel longer than 6 months, you already know which one they choose. They always change the rules. The question is whether you are positioned before or after the rule change. Here is what you need to do with this information right now, not next week, not after the May print hits the tape, right now. First, know what you own. If your silver exposure is entirely in paper, SLV, futures, a mining ETF, you do not own silver. You own a promise about silver. And tomorrow morning is the day that the gap between promises and metal gets measured in public for the first time this delivery cycle. Second, watch the CME bulletin board at cmegroup.com/clearing. The warehouse report drops every evening. The open interest data updates in real time. You do not need a Bloomberg terminal. You need 15 minutes and a bookmark. Third, set your $72 alert. That level is the pivot. Everything above it builds the base for the next explosive leg. Everything below it buys you more time to accumulate at prices that, 12 months from now, will look like someone left money on the sidewalk. The 40% crash from 121 was not the end of the silver story. It was the intermission. The curtain that separated the retail shakeout from the institutional accumulation phase from the repricing event that analysts from JP Morgan to Citigroup to the LBMA are internally projecting at levels that would make tonight's $73 price look like a rounding error. Ray Dalio has spent 30 years documenting what happens at the end of long-term debt cycles. The currency weakens. Hard assets reprice. The transition is never smooth and never announced in advance by the people managing the transition. Powell didn't announce it on his way out the door. Warsh won't announce it on his way in. The CME will not issue a press release when the coverage ratio breaks. The LBMA will not send you an email when the last deliverable bar moves from registered to eligible status. They never do. They never have. The signal has always been the same. The vault numbers, the delivery data, the open interest, the premium spreads between Shanghai and London, and the quiet movement of large institutional money from paper promises to serial-numbered bars sitting in audited, allocated, privately held custody. We are watching the final act of a paper system that has made promises to 4 generations of savers it cannot physically keep. The 76.88 million ounces in that vault are the only number in this entire story that cannot be fabricated, cannot be rehypothecated one more time, cannot be dressed up in a press release. It either exists or it does not. And tomorrow morning, the world finds out how many people want to know the answer. Diamond hands are not a meme. They are a thesis. The thesis is this: rock beats paper. Not sometimes. Not usually. Always, in the end, in every currency regime that has ever collapsed across 4,000 years of recorded monetary history, the people holding the rock came out the other side. The people holding the paper wrote the history books about why it wasn't their fault. Don't be the person who held the paper at the finish line. Stay sharp. Stay stacked. Stay one move ahead. Drop your city in the comments right now, and drop your prediction on where May open interest settles tomorrow. The closest call gets a full shout out in the next video. And if this breakdown gave you something the financial media would never give you, hit subscribe, hit the bell, and send this to one person in your life who still thinks the number on Kitco is real. Because every person we wake up before delivery week is one less stacker handing their wealth to the system that is about to reprice everything. This is Recession Warnings. The May print hits tomorrow. We will be here when it does.